Good afternoon and welcome back to our 2021 ACA series. My name is Casey Hope. I'm the Director of Marketing and Communications here at Medcom Solutions. This is session 3 of our 6-session ACA series. And today we're going to be talking about common filing mistakes and how to avoid them. Just a few housekeeping things to cover. We are recording this presentation and will be able to provide you the recording along with the slide deck after the presentation concludes today. Also, as always, we are open and we welcome your questions, especially when it comes to things that are as complicated as the Affordable Care Act can be sometimes. So we encourage you to put your questions during the presentation in the questions panel. And then me and myself, Tom, and Michelle will address them at the end of the presentation. So speaking of Tom and Michelle, just want to give them a brief introduction here. Michelle Barkey is our Senior Legal Counsel and the Director of our Compliance and HIPAA divisions here at Medcom Solutions. And Tom Neal is our ACA sales guru. He is our expert on ACA and what we have to offer here at Medcom Solutions. And he is with us as well today. Just to kind of go over what we're going to be talking about today, we're going to count down the top 10 common ACA filing mistakes. We're going to talk about how to avoid them, and then we're going to let you know some of the ways that Medcom can help you process through some of those and kind of take the stress off of your shoulders and your employer's shoulders. So what we did to kind of compile all of this information today was we talked to our ACA team. We talked to the director of our ACA department, Crystal Dowell. We talked to some of her team members and her ACA filing experts, and they provided us with the most common mistakes that they see in a year-to-year basis. So what we're going to do today, we're going to count those 1 to 10 and help you and your clients avoid them for the next filing season. So with all of that being said, I'm going to now turn this over to Michelle Barkey. Michelle?
Thank you, Casey. And let's go through our top 10. Number 1, we still get questions all the time is, what is an applicable large employer and do I need to file? More importantly, quite often we get filings that we are doing for a current year and we realize they may not be an applicable large employer, and then we go back to them and we get some more details. So the best way to determine if you're an applicable large employer is go back to the previous year. And the previous year, did you have 50 full-time employees, including your full-time equivalents? And if you had more than 50 full-time, including full-time equivalents the previous year, then you are going to be an ALE for the current year. So for an example, if Company X hit 75 employees, and this was the first time they were over 50 in the year 2020, they will start being an applicable large employer in 2021. There are a couple of exceptions to this. The main exception is if you are a new business and you open with a reasonable expectation that you are going to have over 50 employees, including those equivalents, then you will be an applicable large employer in the year that you were opened. And there's some tricky little details sometimes with mergers and acquisitions. So we always look at a merger and acquisition if one of the two companies that merged had 50 or more employees the previous year. The second thing that comes up all the time, and it's something that we often forget, is those rehired employees. And what the ACA Rehire Rule says is that if you were working for a company and then you terminated and you came back within 13 weeks, you are a rehire employee and not a new hired employee. And you must be offered the same benefits you had prior to leaving and within the first month after you return. So therefore, if you had worked for 2 years and you were a full-time employee, you took the health plan, you left, decided you made a mistake, came back on the 10th week. On that first month after you return, you must offer them benefits again as a rehire. More than 13 weeks, then they're a new hire employee and you don't have to worry. It's 26 weeks for schools because we were worried about those summer vacations. And I believe we have a poll question, Casey.
Yes, we're keeping it simple this week with our poll question. So what we want to know from you guys is, do your clients enlist outside help for full-time employee tracking? It's a question that we get a lot. If it's something that we offer, it's something that we find a lot of value in. So we would like to know if out of all of our participants and our attendees today, if your clients enlist outside help with that tracking of their full-time employees. I'm going to give you just a couple more seconds here. We've got a lot of responses coming in, so I do appreciate everyone who's voting. And I'm going to go ahead and close this poll so that we can share the results here. So 57% say that yes, you do, your clients do enlist outside help for that full-time tracking, and 43% say no, which is honestly a really good thing, as we can tell from the next point that we received from our ACA team. Michelle?
Yes, and employee tracking is one of those areas of concern. Now, some employers don't have the issue because all they do is hire full-time employees, and that's not an issue. But once you get into those variable hour employees, if you're a restaurant or if you have people that, you might be a hospital and you have nurses working various shifts, then we really start to need to track those variable hour employees. I mean, some employers use their best guess instead of full-time tracking. One of the issues with that is if they are not full-time, you're going to run into some affordability issues and you're going to face potential penalties. And that's when it often comes back, once you get those penalties and everybody's scrambling and looking to see whether the employee was really full-time or not. Really should be done before you file the paperwork. And the next area of concern is when to apply a safe harbor. Well, safe harbors were meant for affordability, because if you ask the law what the law says about affordability under the ACA, it says, that it has to be a certain percentage of your household income. It was based on 9.5% to start with, and each year it kind of goes up and down. But again, do you know what your employee's full-time income, household income is? And the answer is, of course not. They might have monies coming in from other sources, spouse might work, even children sometimes contribute to the household income. So not knowing the household income, the IRS said, okay, we're going to give you 3 safe harbors that you can use. Number 1 is the W-2 wages as reported in box 1. However, we won't know what's reported in box 1 until the end of that plan year, because they say if you're reporting on the 2019 plan year, you have to use the 2019 W-2. We can take a guess, but we don't know for sure. The second one that is really good for hourly employees, but not so good for regular employees who are salary-based, is the rate of pay safe harbor. And you take that rate of pay and you multiply it by 130. Why 130? Well, that's 30 hours a week. But you say my employee's working 40 hours a week. It doesn't matter. It is based by the safe harbor the IRS gave us on that 130 hours a week. And then there is the federal poverty guideline safe harbor. So in 2020, this federal poverty guideline was $12,760 for single, and you multiply that by the percentage that we were using for affordability in 2020, which was 9.78%, and it comes out to $103.99. So if the employee for single coverage only did not have to contribute more than $103.99, then you were safe using the federal poverty guideline safe harbor. And understanding the full premium amount. This one happens all the time. We ask the employee, what does the employee have to contribute for the lowest cost plan for single coverage only? Because that's what we're basing affordability on. And what do they give us? They give us the total premium amount. And then all of a sudden we try to plug in that full premium amount. And what do we get? The coverage is unaffordable for all those that waived. So for an example, they might tell us the premium is $250 a month. And then when we go back and we say, hey, that's awfully high, they come back and they say, whoops, what we really meant, and this is just an exaggeration, was $50 a month because the employer pays 200% of the premium. So when you're completing box 15, it is always the lowest cost plan and what the individual would have had to contribute to it for single coverage only. And again, that one is often misunderstood, even today, 7 years later. And premium differences, same idea. We'll ask them, what is the monthly cost that an employee has to make for the lowest cost plan? We don't care if they tell us what the payroll amount is per payroll. We don't care if they tell us what the weekly amount is. Just spell it out. Let us know this is the weekly. I cannot tell you how many times we see that, hey, the employee had to contribute $90 to the plan. We think this is great. We're going to use the federal poverty safe harbor guidelines, only to find out that that's per pay period. And they have 26 pay periods in a year. And therefore, we would have to multiply that and divide and come out with typically around $180 instead of the $90. So it's really, really, really important that we know what the monthly premium is. Tell us in any which way you want to, whether it's payroll every 2 weeks, whether it's this or that, so that we can do the calculations, but just don't give us an amount without clarifying if it's weekly, bi-weekly, or monthly, because that's really important and it makes a difference. Another issue is the coding on that line 14. There is a code 1A, and this is where a lot of the confusion lies. 1A means that you offered coverage to the employee, spouse, and the dependents, and the coverage you offered met, and you were using the federal poverty guidelines safe harbor. So in 2020, the premium for the individual coverage was up for the employee only would not be more than that $103 we talked about. And if you use that 1A, you do not have to complete line 15 or 16. That's great. That's called the qualifying offer. But what we find out is a lot of the time, especially during appeal, is that 1A was used, but they didn't offer to the employee, spouse, or the dependent, or it was not by using the federal poverty guidelines safe harbor. And the IRS knows this too. They know that this code is greatly overused, so we never recommend using it. You can still put code 1E with the amount of the premium, spell it out, flaunt it. It's under $103, flaunt it, and then put 2G that you're using the federal poverty guidelines safe harbor. What we think that code 1A does is invite an IRS audit. And we say if you're using the federal poverty guidelines and if you offer to the employee, spouse, and the dependent, flaunt it. Let the IRS know all that information up front so that you don't risk that potential audit down the road. Now, 8, who receives a 1095? We get this all the time. We have 108 employees, but we only got forms for 75. How come? How come not every one of the people that worked for us for a year got a form? Well, the IRS says you only give forms to full-time employees. And what is considered a full-time employee? Number one, it's an employee that works 30 hours a week or more on average, or 130 hours a month, but that's only part of it. The second definition, as far as filling out the forms 1095, is has that employee satisfied the waiting period? And has that employee also, or measurement period? So for an example, if you were coding a form and never offered the employee coverage for 1 full month during the plan year because they were hired towards the end of the year and they were in a waiting period, and therefore you had, maybe 1 H2A, not an employee for so many months, and then you started to use 1 H2B, that they were in a waiting period, and for the full month they never got benefits, then they are not a full-time employee at that point, and you would not give them a form. So the other thing we notice is that a lot of times employers try to give us data at the end of the year, and they say, okay, here's all 12 months, do it. That's fine, but it really is better to get it periodically through the year, either monthly or quarterly. That way we can do more work for you. We can actually look at it and determine whether or not you're on track. We can let you know if you're running into affordability issues, and we can also let you know if some of the information is just not correct. So it gives us more time to help the broker, and the broker more time to help the employer. So it really is important that we get information more than just at the end of the year, here you go. And 10, planning for next year, always, always, always important. We learn from past mistakes, don't we? We learn that if we need to give information more often than at the end of the year, we look at those affordability safe harbors because they change every year. Sometimes they go up, sometimes they go down. For example, in 2019, affordability threshold was based on 9.86%. What happened in 2020, it went down to 9.78. So premiums sometimes have to be adjusted for the individual's contribution. And also, if we look at it from planning from each year to each year, all those other 9 things that we mentioned could be at issue, is now coming to a halt when we plan for the next year. Do we have tracking in place if we do have those variable hour employees? Do we really understand what we did last year so that we can make sure we do it better the following year? Do we understand where the mistakes were? So planning from year to year is always something that you need to do. And with that, I'm going to turn it over to Tom Neal so he can talk about Medcom and our solutions for your ACA reporting nightmares.
Thank you, Michelle. Great information. I really appreciate you and our ACA team putting that together. I think the best thing I can say to start this off is something that we've said several times in this webinar series, and that is that the best defense is a great offense, and Michelle really hit that point. We are right now currently working on our renewals of our current ACA reporting clients to get them set up for 21. And the reason being, again, is because getting started early can find those issues that might crop up. And right now, they're not hard to fix. If you wait till, late in the year, October, around that time, it's too late at that point to fix some of those issues. So the earlier, the better. The key for you guys, I know you're wanting to take care of your employers, your clients, is to make sure they have the right solution in place and the vendor that is handling it. As we mentioned in the previous webinar, you now have the American Recovery Act that also has made some changes, and it's going to make that marketplace more attractive to some employees. So again, you need to make sure that the insurance offering does meet the affordability test and that the coding and everything is done correctly. We obviously can do that. I mean, we have a great series of products, but the most important thing we have are the experts behind it. We know how to do this. We know how to do it right. And as I said, we will be that great defense because we will be on the offensive and get it done before it would ever be an issue. I'm sure most of you know we do have our full service ACA employer reporting. We also have that ACA FTE tracking, and Michelle mentioned it, some of the issues. This is for your seasonal or variable hour employees. And again, you want to be ahead of that so that the employer knows beforehand when they need to offer benefits or not. We also, Michelle heads up our penalty appeal support team. We're currently sitting a little bit over 50 million in proposed penalties that we've been able to mitigate. Again, you want to avoid penalties, but if they do happen, we can help. And this product is open for those employers that we don't do the reporting for. So if you have someone or a new prospect and they come to you with what we call an IRS love letter, we certainly can take a look at that and help you with it. We also offer ACA backfiling. We're one of the few vendors that do that. I'm continuously working with employers that didn't realize they needed to do this and haven't done it from the beginning. So we're going all the way back to 2015 and doing the whole thing for them. And that's something we're happy to do. And I'm sure Michelle will agree with me. One of the important things to do when you're dealing with the IRS is voluntary compliance. So getting ahead of that curve before a penalty even if there are back filings and there may be late penalties, get started on it because that will definitely help mitigate any issues. And then finally, we can also offer consulting and strategic evaluations. If you've got a client that just needs a little coaching or is looking for a mentor, that is something we can talk about. So the entire range of our ACA solutions were put in place so that we can give you that edge when you're talking to your current clients and your prospects so that they're covered for the ACA. And to kind of give you a little more detail on the reporting itself, just to give you how, what goes through that and what is included. I mean, first and foremost is the strategic planning. They're going to have an account manager assigned to them, and they're going to start off by asking them about the specifics of that employer. Everybody's different. Everybody has different challenges and issues. We want to make sure right from the get-go that we're all on the same page. We're getting what we need. They know what we're doing, and alleviate some of that stress. Data management. Data is the stress. Data is the reporting. The big thing to remember is we're easy. We have a team of data technicians that work with our account managers. They will take the data as long as it's in a usable format, any way they can get it into the portal wheel set up for the client. And we will put it in the format we need to do the reporting. That is included in the service. But again, it's just something to take a little bit of that stress off employers. Next, we're going to do an analysis and validation, make sure there's nothing unusual standing out. We have a proprietary system that'll look at that, but more importantly, we'll also have a set of human expert eyes looking at it. No product is a standalone. At Medcom, we have experts who are actually looking at it to make sure it's done correctly. We'll offer a model notice. We'll email that over. It's a blank 1095, but it has explanations for each box. That's a great tool, especially for employers that have never done reporting for. It'll answer a lot of their employee questions. And then we have external validation. At the end of the day, the employer is responsible for this reporting no matter who does it. So we want them to see what we're doing, understand why we did it, review it, and agree with us. Once that's done, we will print and mail those forms. And then once that is complete, we will then electronically file those forms through the IRS AIRS system. Again, that is all included in our full service ACA reporting. We also offer some other solutions. And again, these are great products, but more importantly, it's the expertise behind them. We know how to handle each and every one of these. And so those questions, issues, problems are going to be alleviated because we're going to take care of it for both you and your employer. We have our CDHP and COBRA premium billing teams. We have HIPAA privacy and security solutions. We also have our health and welfare compliance and actuarial solutions. Again, the name of the game for Medcom is to make sure that we're giving you a competitive set of products so that you can garner more business. And at this time, I'm going to hand it back over to Casey so we can see if we can answer any of your questions. Casey?
Excellent. Thank you so much, Tom, and thank you so much, Michelle. Also, a huge thank you to our ACA team for all of the work that they do throughout the year, but to also provide us with these common mistakes that they run into. I mean, how better to help you guys prepare and help your prospects and your clients as well. If at this time you have any questions for us, go ahead and put those in the questions panel and we'll discuss them now while we have the experts here on the line. So Michelle, our first question here, we mentioned in several of the points earlier that some of these mistakes could heighten the risk of potential penalties, but when it comes down to it, is the IRS very serious right now about collecting those penalties?
There's two reasons for it. First off, we've had a change in government, and don't forget that President Biden was one of the architects of the Affordable Care Act, and he has made it very, very clear that he intends to increase the compliancy with the ACA and the penalties. Second off, we have seen an increase in the amount of penalties, and we're getting the IRS is back at work, and we're seeing a great influx in the amount of penalties that they are trying to collect. And there is a third reason. Back in June of last year, the Tax Inspector General for the Taxpayer Advocate wrote a scathing report to Congress about how the IRS was not living up to its expectations of collecting penalties. And the IRS is now playing defensive with Congress on that. So for all three of these reasons, yes, the IRS is getting very, very serious about collecting penalties, and we're seeing more and more of it.
Yes, we are. I've seen those come in recently. It is definitely increasing. But what are the odds, Michelle, of an employer being targeted for filing years before 2018?
We're seeing it again, 2017, 2016, 2015. One of the things I do want you to know is that the chief counsel for the IRS has indicated that there is no statute of limitations on the reporting for the ACA, the 1094s and the 1095s. So they can come back at any time. And just because we think we're over 10, the 15, 16, and 17 tax years, we are seeing more and more coming back now, and they're going back and they're getting more information. So again, don't think anything is settled with the IRS.
Thank you, Michelle. Tom, can you tell us a little bit more about why Medcom Solutions and ACA full service solution is preferable to, say, a payroll vendor?
Absolutely. Usually a payroll vendor is more about the data manipulation. Obviously, they already have much of the information, but in most facts, they're not ACA experts. They're more about manipulating data and being experts on payroll. So while they may have a dashboard and some, on a fancy site, they may not have the expertise to understand some of the minutiae. For example, what Michelle has talked about in this presentation, they may not understand the nuances of not using that 1A code, or what's the best safe harbor or harbors to use, or in fact, what is the best look back period. So, there are different levels of reporting products. And what we look to do is to do the full service where we have experts, because our idea here is employers are experts in running their business. They're usually not experts in this. And I would think the same thing with our brokers. And so this is what we are experts on. We want to take this off their desk so they're not worried about it, and we avoid those types of pitfalls.
Absolutely. Thank you, Tom. Another question about possible back filing and audits. I mean, how can we help clients or prospects of clients audit past filing years as a way to kind of close more business and get more accounts?
One of the things that, you can always say is that, again, as we indicated, there is no statute of limitations on the ACA reporting, and there is no statute of limitations on reporting that went bad. So that's one of the things that we always have to look at is what was the past filing like and what is the future filing like, and go from there. For example, I have a client now that I'm working with that filed in 2015 and 16, 18, 19, and 20, but missed 17. And so now we're trying to go back and figure out what happened in 17. So there's a lot of those issues that come up regularly, and it is a question of looking at past filings to make sure that future filings are correct. All along we have had those, good faith years. If you don't make a mistake, it's okay, and we'll just move forward. Well, those good faith years are now being defined, and the Tax Inspector General has actually asked the IRS to define, looking back, what good faith means. And if you're making the same mistake over and over and over, is that really good faith? So again, I think that it behooves everybody to go back, look what they did in the past and how they can improve it in the future.
And I would add to that, Michelle, the bigger picture, at least it is as you're working with your prospects and your current employers, is it's that the comprehensive view you're doing. These kind of questions and asking their client about this shows that you're trying to be comprehensive. Now, I would believe that while you're selling to these clients, you're trying to sell them the full package suite of what you do, and more importantly, that you care about them and that you're looking out for them as it pertains to all types of compliance issues. And this is one of those items to where you are taking that step to show that you genuinely care and want to make sure they avoid issues.
Absolutely, I think that makes perfect sense. And so, Michelle, if a current client gets in a negotiation with the IRS about some of these penalties, can Medcom help them in that situation?
It all depends on what kind of negotiations. Like if you've already filed a tax and you're and you're waiting for the IRS to come back, your best bet is to just continue what you're doing. If at the end of the day you don't have satisfaction, then you can come to Medcom and we can take a look at it to see if we can help you further.
Excellent. And Tom, a question about how we put our ACA solutions out there is, do we offer any volume discounts for moving like a bigger block of business to Medcom?
We can certainly discuss that, as it would be with any of our products. That is something we can put together a meeting, we can discuss and look at what the broker is trying to do, how many groups we're trying to put together, and what the ideal solution, and we can certainly look at some pricing for a block of business.
And if once people kind of transfer over, if a business is switched over to Medcom, does that person work with one specific person within the ACA department, or is it kind of and everybody tackles one account? So do we have dedicated account managers?
Absolutely. Year over year, they will have the same account manager. In fact, our team, who's under Crystal Dowd, who's the director of the ACA team, has very few turnover, very low amount. So her team are very experienced and trained. And again, the same person will be with that client year over year, both for the reporting and the FTE tracking.
Thank you, Tom. Thanks for that clarification. Definitely gotten some really good information this afternoon, not only from the questions here, but especially focusing on those top 10 common mistakes that we see, and hopefully will help our participants, our attendees here today, prep their clients and prospect to new clients about how to best prepare their ACA filings for next year. And as always, if there are any questions after we dismiss today, after this webinar closes, please feel free to reach out to us here at Medcom. As I've mentioned before, Tom Neal is our resident ACA expert and can really counsel you and your clients about the services that we offer and how Medcom can potentially help you. But myself and Michelle are also available to reach out to you as well. We certainly appreciate your attendance here today. We will be able to send out the recording and slide deck after we conclude. And we will be back in 2 weeks with our next ACA webinar series. So thank you again for attending. Thank you to Tom, thanks Michelle, and thank you to Medcom's ACA team. What a wonderful group we have here, and we really appreciate you. Hope you have a wonderful afternoon.